Hello Discord members, and welcome back to another one of our videos. And in today's video, going to be a hotly requested topic, that of the basics of fundamental analysis. Special emphasis on basics. I'll be telling you guys all of the relevant metrics that I feel are worthwhile when looking for solid companies and determining whether or not those companies are trading at fair prices. In my opinion, although there is thousands of fundamental ratios and statistics and everything under the sun that you could possibly analyze about a company, there are really only a few that stand out more than the others. And it is my firm belief that if you are not able to get a sense of where a company stands, whether it's cheap or expensive, just by looking at these few key metrics that I'll show you in just a moment here, well then probably there's something either wrong with the company, or if you need to look too deep, if you need to go too deep into the ratios, then maybe the company just isn't so clear and maybe you just shouldn't be buying it in the first place. It really needs to be easy. One of the biggest fallacies about fundamental analysis is that more is better. That's actually not true. Less is actually more in terms of fundamental analysis, and you will see why, guys, because a lot of fundamental analysis is relative. It's not an exact science. There are no true laws in finance, such as the law of gravity, which you can prove and repeat time and time again. That is a scientific law. Most of fundamental analysis is relative valuations based on assumptions and based on modeling. Notice how I say assumptions and modeling, because those are two key things which you don't find in other law-based sciences, such as pure applied mathematics, right? Physics, and such as maybe, medicine and stuff like that, right? So it is all relative. That being said, today's course is going to be just an introduction. So I'll spend about an hour on it. There'll be a lot of concepts thrown at you, but as with everything, guys, it's just a question of practice, right? I don't expect you guys to learn all of this overnight, but hopefully after this introduction, you guys can ask me more questions and you'll see me do more and more of these analysis excerpts either after earnings or throughout the live streams. And always feel free to ask me any questions if you're not able to do something on a specific company or if you don't understand something, and I'll help you, shed some light onto whatever the issues is, okay? So that being said, let us go over some notions of fundamental analysis first, yeah? And I'm going to be using this good old chart of the SPX to do it. So don't read too far, just go with me line by line. I'll spend literally 4 or 5 minutes on this, okay? So number one, a stock's price is a reflection of future earnings and future cash flows. Nothing more, nothing less. You can throw in a bit of momentum, you can throw in a bit of investor sentiment, all that good stuff. But at the end of the day, it usually always comes back down to this. That being said, do not chase the market ever. Let the market come to you. There's over 500 blue chip stocks in the market, over 8,000 total. You will always be able to find something, so do not chase the market. Now, in terms of what I like to look for in a company, the company needs to have a clear competitive advantage in its industry, aka a moat, right? If you cannot say clearly what the company's competitive advantage is, well, then maybe it's not going to be such a good company for your long-term portfolio. It needs to be absolutely clear. I'm pretty sure if I mention the names such as Netflix, such as Microsoft, such as Amazon, it's very obvious. Visa and MasterCard, Costco to a certain extent, right? Some of them are very obvious, and those are going to be the easiest ones to do. When you get into an industry like cybersecurity that you don't know much about, do you really know which one in cybersecurity has the largest competitive advantage across this industry? Probably not. So when I'm looking for long-term portfolio plays, they need to be obvious. Number two, consistently increasing revenue and EPS. You guys will see why that matters, but I'm pretty sure if you've been with me for a while now, I put a lot of emphasis on this, guys, because a stock's price is a reflection of future earnings and cash flows, and there's no better way to guarantee that by consistency and revenue of EPS. Now, number three, consistently increasing free cash flow. I'll talk to you guys about free cash flow and why that matters as well. That should be one of your largest concerns as an investor in a company, because this free cash flow at the end of the day is yours. And I'll explain that a bit later. High return on capital employed, high return on invested capital. Can they leverage internal cash properly? You guys will hear me talk seldomly about these two ratios, but they do matter. You can go on a website like Guru Focus to find what they are. I don't expect you guys to calculate this manually. All you need to understand is whether the company is, when the company generates $1 of earnings or receives a dollar from investment, either by issuing bonds or from their stock, what do they do with that money? How well can they leverage that dollar into future returns? This is why these two metrics matter. They are arguably the most highly correlated to a stock's long-term performance. So if you're looking for filters for stocks above 15% ROC and ROIC, traditionally, you're guaranteed a long-term annual ROI of roughly 15% over a 10-20 year period. Number 5, relatively low debt. That'll matter as well when we take a look at free cash flow and how they can service that debt. Obviously, if a company's worth, I don't know, $5 billion and they have $100 billion worth of debt, well, you guys probably wouldn't want that deal either, right? Makes perfect sense. And number 5, you want to try to find them at support levels, monthly or weekly support levels. And the name of the game, guys, is always solid fundamentals, but don't forget about that great technical entry. That being said, more about valuations for this introduction. Valuations are a direct reflection of EPS all the time as a factor of price to earnings. That's when you'll always find a stock trading at a multiple, X multiple, right? But it is speculative. It's not an exact science. Who choose what is a fair valuation for a stock, right? Why do banks only trade at a 10 price to earnings? Why does tech trade at a 25, 30% price to earnings, right? Why aren't banks at a 4 to 5? Why is that not the industry standard? Why is the industry standard not for tech not 10 to 15? Why is the industry standard for the S&P 500 15 to 18? Who says that, right? Why is that the case? It's an accepted relative valuation over time, and it has increased over time. In the 1960s and 70s, the SPY was trading around, a 12. That was fair. Now the new floor is 15 to 18, I guess. So as you can see, guys, it's not an exact science, right? Who chooses what's fair? Well, nobody. It's just a market consensus, the byproduct of many, many, many participants buying and selling and coming to a common consensus as to what floors should be in terms of cheap and expensive. That's why it's a bit tricky, right? Now, it does change depending on market conditions. As you can see, when a market contracts, valuations do contract as well, and people's degree of willingness to pay a certain multiple for a stock can change as well, right? When you're in a recession, maybe you don't want to pay 35 price to earnings for a company. Maybe you only want to pay 20, and that's why they go down to 20, because that's when people start bidding again, right? When people reduce their expectations, they are based on historical or future performance. So a company that is historically traded at a 25 price to earnings, well, that's based on historical, right? Or future performance. If they're trading at a 25, but they're increasing earnings by a lot, maybe Wall Street allows the stock to trade higher. And by allow, I mean that when retail buys more and more of it, Wall Street doesn't dump on you claiming the valuation is too high. Maybe they also stay in and say, yeah, maybe this stock trading at 25 can go up to a 35, right? It's all relative. Now, understand lastly that the market is long-term rigged for the upside. Assets will always outpace the rate of inflation, and that you always need to stay invested. This fundamental analysis, guys, should mostly be used for long-term portfolios, but it does not hurt to also use it when looking for deals for swing trades. It's just an added component. It is not the end-all be-all, okay? A lot of people rely on this as the end-all be-all. It's not. It's a great factor for determining whether or not a stock is a great price or not. But then again, I can show you guys many companies that trade really cheap that you guys probably would never buy, either because you don't trust the company, you don't believe in the company, you don't know the company, right? So just because a company is cheap doesn't mean that it necessarily needs your investment dollars. It is just one of many factors, which is what I try to teach you in the Discord overall. Look at the holistic view of a stock, right? The sentiment, their future prospects, the technicals, and the fundamentals, right? It's a holistic view of a stock overall. So that's a short introduction into that. Now let's get into the juicy stuff, okay? So if we move on into my other chart, which I put it on the TSX actually, funny enough. Let me just move down here. Okay, so fundamental analysis. These are, I guess I should spell it correctly, fundamental, okay? So maybe I should spell it correctly first. Okay, so we will be going over these 4 topics. Don't get ahead of me. We'll go through these one by one. If not, I'm going to have to hide the screen on you guys, right? So we'll go through these one by one, and I'll give a descriptive and descriptive analysis of what each and every one of these means, and also go through several examples as I reference through the analysis, right? So I expect you guys to bring me more examples if ever you're curious about something, but now there's only so much that I can do in terms of an hour, right? I don't want to make that. I can make a fundamental analysis course for like 5, 6, 10 hours, right? Now we're just going to go over the basics and why each and every one of these matters and how it plays into different stocks amongst different industries. The primary focus that you'd always be looking for, guys, are profit margins. Everything else comes after. If a company does not have positive net margins, you have to ask yourself why. The first question you need to ask yourself whenever you're looking at a company is, how does the gross margin translate to operating margin and net margin? All fancy terms, I know. Let's take Microsoft here, for example, okay? We go on to Microsoft, we go down here to more financials. I'll show you the statistics. What is gross profit margin overall? Well, gross profit margin is, if I can find it, gross profit margin essentially, you can always click on the descriptions here. It'll tell you what it is, right? It's, I don't know. I'll just tell you what it is, yeah? Gross margin is basically when you have a product that sells for $100, okay? How much did it cost you to make that product? Forget about the sales, the marketing, all that stuff. All that stuff is an operating margin. I'm talking about if you make a chair, how much do you spend on wood, okay? And then also, how much do you spend on labor to make that wood? How much you spend on the wood, the glue, the nails, and the labor. So when you sell a chair for $100, what is the building cost of that chair, including the labor and the materials? At the end of the day, if I make a chair for $100 and I'm only into it for, my cost is only, well, it's 1 minus this, 1 minus 68, right? Well, my cost, right? My cost of goods sold would be 32% right here. This just means that when I sell a chair for $100, okay, and after I reduce my costs of goods sold, I get to keep $68. These are very good. Now, each industry will have different gross margins. If you want to know overall tech margins, you can go through a few of these. If you look at the Mag 7, you'll see Meta has slightly higher than Microsoft because Microsoft sells products. Usually, if you're a software company, you'll only have higher gross margins because there's not that much cost of goods sold. It's all labor, right? There is no physical materials that you have to use. So here's Meta's gross margins. Amazon is a product-intensive company, so you can't expect them to have as high margins as Microsoft and Meta that are more focused on software. So as you can see here, Amazon's gross margins are very good for a largely product-based company, but they are still nowhere close to SaaS companies, right? A lot of the cybersecurity companies like CrowdStrike have very high gross margins because all they do is sell software. If you want to find product-intensive companies, you can look at something like home builders, right? Like a Toll Brothers or something like that. You'll see their gross margins are 25% because there's a lot of materials that goes into building it. There's a lot of labor as well. So hopefully that makes sense, right? So these gross margins, you can logically understand that if, the cost of making your product is not materials and or labor intensive, you should have higher gross margins. The biggest examples of these to the upside are something like a Visa and a MasterCard. They have very high margins, like cybersecurity, like tech. All they do is run a payment network. But if you look at an oil company or something like that, take a look at ExxonMobil, it's a very capital intensive business, right? The parts, the labor, everything to run an oil company, oil rigs, pipelines, all that stuff. Now you understand that some of these companies, they have to spend, right, a lot in terms of cost of goods sold. Whenever they sell their products, it costs them a lot, so their gross margins are not very high. Hopefully that all makes sense, yeah? Let me get back to my list. How does the gross margin translate to operating and net margins thereafter? So gross margins is cost of goods sold, as I said. Operating margin are what you call the reduction of when you get to gross, then you subtract after cost of goods sold is removed, you then go to your operating expenses. So these are the costs of building and, building the product itself. Then you have the costs of running the business. That's why they call it operating expenses. It's the expenses that you incur while you're running your business. So overall, if I take a look at Microsoft's financial statements right here, and we go all the way up here, you will see that these right here, they don't say operating expenses. A lot of other companies will help you out. They'll say cost of goods sold here. Here's the Microsoft listed at cost of revenue. Then it'll say operating expenses, and it'll give you a breakdown. They are always broken down into 3 categories on any single income statement. It'll always be research and development, which is very logical. These companies need to spend money to research new products. Then you have sales and marketing, right? How much does it cost you to get your product out there in front of the public eye? And then lastly, you have general and administrative expenses. Now, there's a host of different things under this. Sometimes there's stock-based compensation, there's other miscellaneous expenses, but usually G&A is going to be the lowest component of operating expenses. You can look into this one on your own. You'll see there's like 100 different things that you can include in general and administrative tasks overall, but the biggest ones will always be R&D and sales and marketing. After you've reduced your cost of goods sold, cost of revenue for the product, then you've reduced your operating expenses. How much does it cost you to operate the business, right? Then you get what you call an operating income. Operating margin is just operating income divided by your total revenue received. Then that's how you know, okay, well, if I can see, if there's a discrepancy here, right? If I go to Microsoft real quick, okay, and I go to operating margin, you'll see that they make gross 68. Then operating margin, they make 45, right? So you can see that they're not losing too much here. Now, there's no specific rule to say how much of the gross should be carried into operating. It is really sector by sector dependent, right? Some companies, when they're really growing fast and they have to do a lot of sales and marketing and a lot of research and development to be on the cutting edge of technology, some companies will look like CrowdStrike, whereby they have very high gross margins, but since they spend so much money on research and development and sales and marketing trying to be the best, well, you can see that although they have very high gross, they bring absolutely nothing. They spend it all on operating expenses, right? And that is a problem. It's good though, because when you have high gross, as you scale revenue, these operating expenses, traditionally, if the company knows what it's doing, are going to become less and less of a portion of revenue. You know, sometimes I reference the charts, guys, when I show you the charts and I'm saying operating expenses are becoming less and less of a percentage of revenue. That's what I mean. A good example of one that flipped recently is something like an Uber, right? They always had really good gross margins, but you can see they were spending a lot on R&D for their app and their technology, but a lot on sales and marketing, a lot of promotions, getting their app in front of the most amount of people. So they started off with low operating margins. And as they scaled revenue quarter by quarter, their operating margins are actually getting better. This should be a trend that you're seeing in growing companies. They should be able to be getting better and better at operating margins. For legacy companies that have been around for a number of years, guys, especially some of the bigger tech players like, Apple, Microsoft, Google, other companies like, Oracle, or companies that have been around for a while, right? You'll see fairly stable operating margins over time because they've now scaled into the latter end of their business, right? They're no longer high growth companies spending a lot on costs. Now they're kind of a mature business and they just grow over time. You can see here on Apple, we're right down here at about 34% operating margins. This has always been the case. They've always ran about mid-40s gross margins for like the last 5, 6, 7 years. Mid to 30 operating margins. It'll fluctuate a little bit. And net margins have also been relatively stable. Now, the number one time that you want to pay attention to the evolution of operating margins into net margins as well is when a company is not profitable, such as Uber was back in the day. Uber was not profitable. When a company is not profitable, you have to take a look at every single quarter. Are they taking the necessary steps to translate gross margins into both operating and net? And when you see the flip start to happen, beautiful things can start to happen as well, such as a firm. A firm is a technology company. They always had high gross margins. As they scale, they now move into positive operating margins and then finally into positive net margins. When you see the flip from negative operating to positive operating, you pay attention. When you see the flip from negative net margins to positive net margins, you double pay attention. That's how you know that a non-profitable company is becoming profitable. Several cybersecurity companies are going through that right now. Here is Cloudflare. high gross margins. They're improving operating, but it still is not translated to the bottom line. So you need to pay special attention during earnings calls or during companies' earnings presentations as to what is the timeline for this company to be profitable, or will they ever be profitable, right? Sometimes it's 1 to 2 years away, sometimes it's further away. That will help you out with the guidance overall, okay? When looking for these companies, these are just a few examples. Another one is SoFi. SoFi had always high gross margins overall. It fluctuates, but it's still good. Operating margins are kind of a toss-up. They were a very small company back here. But if you just take this on a normalized basis, you can say that they're always around 10, something like that. And now they're finally bringing more of it more consistently to the bottom line. These are quarterly statements. Even a company like SoFi is somewhat choppy, but you'll find that even a company like Palantir, right? Palantir as well, same concept. Always high gross margins, decent operating margins. Now they've been getting better, save for one quarter when they did a one-line item. I digress. Now they're high. And look at net margins. Now net margins have been improving. Palantir was not always a profitable company. It was net negative. I was paying attention. That's why I invested in the company, because it was net negative. We had a clear timeline and a clear revenue ramp schedule that would allow us to scale high gross margins into positive net margins. The companies that I do not like sometimes are companies that have thin gross margins, very thin operating margins, and barely any net margins. Those you really have to be careful about, guys. Talking about sometimes the furniture companies or heavy industrial companies, they'll have very thin growth. They'll have not that high gross margins, 20 to 30%. Their operating margins will be razor thin, like 5-6%, and their bottom line net margins will be either slightly negative or slightly positive, and they'll run a lot of debt. Those are the companies that I don't like to find. I like high gross margin companies, decent operating margin companies as well, 20, 30+%. And then bottom line, I love to find companies that can bring in an excess of between 10 to 20% to the bottom line overall. So that's enough about gross margins. Hopefully that explains to you guys what I'm looking for across all these various levels of margins. And operating leverage is the last one to kick it all off. You'll hear me reference this term a lot. Is a company growing revenue faster than its growing expenses? That's why you know a company is operating leverage. You will see that when a company is able to have higher and higher increases of operating margin over time. That is when you can say a company has positive operating leverage. As it scales revenues like this, the expense profile only goes like this, okay? Because cost of goods sold is cost of goods sold. It'll always be the same for the most part. That's why gross margins are the same for the most part always. Where companies get it wrong is operating expenses all the time, okay? You need to see, are operating expenses only growing like this while revenue is scaling? This gap, okay, is what allows you to grow this and also your bottom line net margins, okay? So that is the most important portion when I'm looking for profit margins, is how do these all intertwine? You will see that different companies have different profiles. It depends on the industry, right? I showed you a number of different industries. So hopefully now you guys understand that when you're looking at a cybersecurity company, compare it against its peers. When you're looking at a bank, compare it against its peers, although banks are a bit different. When you're looking at an industrial company or Lockheed Martin, compare it against its peers. When you're looking at a food company like Chipotle, compare it against its peers, okay? Don't start comparing an apple with an orange. Don't start comparing Lockheed Martin with Costco. It's not going to work, right? It's relative valuation amongst the sector and amongst its peers, direct peers, the closest ones you can find, right? Because food and beverage is very large. Can I really compare Coca-Cola with Texas Roadhouse? No, I have to compare Coca-Cola with Monster Beverage or with Pepsi, and Texas Roadhouse, I have to compare it with other sit-down style restaurants, right? That's what I mean, comparing it against the whole sector or comparing it against direct peers. Keep that in mind when you're looking for various companies there, all right? Number 2 is a very big one as well. This is the concept of price to earnings. Now, this is the one that you'll hear everybody talk about all the time, price to earnings. But as I was saying, right, banks, look at Bank of America, they always trade at 13 price to earnings. So, and something like like an Amazon always trades at 30 price to earnings. Now, you cannot say with a blanket statement that a Bank of America is cheap and Amazon is expensive. It doesn't make sense, right? You always compare it to the sector peers and the common industry, right? Why do certain industries have different price to earnings ratios than one another? Well, that's just kind of the way it goes, guys, okay? So tech companies usually grow faster than banks. Banks are mature. They don't have the same risk profile either, right? They have an entirely different business model than a company like Amazon. And they're, a bank's reason of being is not necessarily to grow the fastest as possible. Their reason of being, reason to exist in the first place, is just to grow revenue, grow margins, generate interest income, and return as much value as possible to shareholders. A company like Amazon is a company that wants top-line growth and grabbing market share at all expenses, so it reinvests a ton of capital into its own business, and the shareholders, in terms of payouts like dividends and other stuff, those kind of come second, right? So that's why I say you cannot compare a bank to Amazon. You cannot go cross-industry. Some industries like oil and gas, right, you'll find the same thing. If I just go on several oil and gas companies, you'll find that for the most part, they always trade at a 12 price to earnings. Why? Because these companies are very cyclical. Their revenue cycles are very cyclical. It depends on the price of oil. It depends on seasonal demand. And as you can see from the EPS and revenue profile here, it's just not so consistent. But this is not the only one that's like that. ExxonMobil is the exact same thing. Chevron's the exact same thing. So lack of consistency is also a reason that a company's price to earnings multiple will be low, or an entire industry will be low. A same type of industry is the home builders, Toll Brothers. Although the revenue and EPS streams appear consistent, the housing market is very cyclical. So when we look at home builders, they trade at very cheap price to earnings ratios. There's Toll Brothers, there's DR Horton right here at about a 9, here's Lennar, and now these fluctuate between a roughly 7, 8 and like a 12, 13, but never higher than that. Don't get fooled by their appearance of somewhat consistency here. It's just not a very consistent industry over time. It's very difficult to predict where the housing market's going to be in 2025, 2026, 2027, because it depends on the cycles of the economy. The same cannot be said about a company like Microsoft. Microsoft is very consistent. It's proven that throughout various forms of business cycles and various cycles in the economy, it can generate revenue and EPS in any given market. That is why, even though it's part of the tech company, it also trades more rich than a lot of other tech companies out there, yeah? The same can be said about companies like Walmart in their own respective niches, or Costco. Walmart always has a higher than average valuation as opposed to some other ones, such as maybe like a Kroger company, right? Kroger trades at an 18. If you just do comparative analysis, although Walmart doesn't only sell groceries, if you were to just take Walmart groceries versus Kroger groceries, why does Kroger only trade at an 18, even if it's pushing all-time highs, and Walmart trades at a 39? Well, it's because Walmart has proven that throughout various cycles of the economy, and through its sheer size, that it is a dominant player, right? It is an international player as well. Kroger grocery stores are fun, but they're only based in the United States. All of these things play a factor. Costco is also an international grocery chain overall. Costco trades at a very high multiple. Why? Well, because its customer base is extremely loyal. When you look to justify a price to earnings, sometimes it's beyond the numbers alone. Sometimes you have to look a bit deeper into the business model and figure, why is it trading so rich? The retention ratio of Costco's clients is very, very high. The retention ratio of Walmart's customers, who are usually, not all the time, but they have a large proportion of lower to middle class income customers, and they will always have that recurring business overall. If people don't want to shop at Kroger anymore because times are rough, where do you think they're going to pivot to? They'll probably pivot to something like a Walmart. You know what I mean? It is a step down. They're willing to take a slight step down, maybe in terms of quality, just to get a better price, which is why Walmart gets a higher multiple. Now, of course, Walmart has different business, a different business. It sells more than just groceries, but the comparative analysis should be always the same. You are trying to find, why does a certain company trade more rich than its peers? Why does Microsoft trade at a 34, right? But something like a Google, which has several similar lines of business, always trade between right now it's a 15, but Google sometimes can barely get above 30, right? Because Google, although it's very good, right, it hasn't shown the same essentially the same history. Microsoft has more history of proving itself through different business cycles, right? Google is a younger company than Microsoft overall. So keep that in mind. Every single company has a different reason, but usually when companies are allowed to trade above a 30 for extended periods of time, there is one determining factor that allows them to do that. And what is that determining factor for the most part? Usually speaking, it is a undeniable moat that is very, very, very tough to challenge. That is what gives a company its ability to trade higher, such as companies like SPGI, which are always 40 and above, companies like Moody's corporations, which are always 40 and above, roughly, such as companies like, Visa. These are very hard to disrupt. These always trade at the midpoint price to earnings of mid-30s on a trailing or forward basis overall. So keep that in mind. Usually when it trades at a historically high price to earnings, it's synonymous with a large moat, okay? Now, obviously, there's tons of different metrics in this. Like you can see sometimes HIMS and Palantir trade really, really high in terms of price to earnings because they're growing really quickly. But I digress. We will get into that in just a few short moments, right? Number one, it's just the biggest single contributor to share price. It is relative to the peers in the industry, which is what we just looked at. Price to earnings as well is best for stable EPS companies. Okay? It is best for stable EPS companies. I will go back to my example of Palantir and HIMS. Why do these trades so ridiculously expensive? Well, price to earnings is share price, divided by EPS. It stands to argue that if a company has just made its way into profitability and has just flipped EPS onto the positive side, right? Just flipped it and is coming off zero, well, they don't have $10 of earnings per share just yet. So when the price of the stock gets so high and the EPS is a relatively low number, you end up with a very wild price to earnings metric. The same thing happened initially to NVIDIA. As you can see, when NVIDIA started rallying, they were only making $1 to $3 earnings per share. But now the company's making $5 to $6. They've doubled it. So this, I would say, is not consistent. This is an exponential run. What Palantir is doing right now is an exponential run on EPS as well. You can view that by the sheer size and scale of the EPS growth rate. Whenever you see an EPS growth rate above 30%, it means a company is scaling extremely fast. Another example is Mercado Libre. You will not always have an above 25 to 30% EPS growth rate. It is just impossible. Eventually, the law of large numbers catches up to you, right? But when you find these companies in explosive EPS cycles, you have to think twice about using price to earnings as a end-all be-all. Those of you who would only use price to earnings on Mercado Libre would think, man, this stock is so expensive, right? No. You're forgetting they're growing EPS at a very, very fast clip, right? It is always all relative. Even Palantir, though, even despite growing at a very fast clip, when you go to the PEG ratio, this is crazy, right? I'm fine with finding a company at a 50 price to earnings, growing this number at a 20 to 30. That means I'm still around a 2 PEG. But when it starts getting crazy, it's crazy. This is the peak example of ridiculous valuation, right? Another one is HIMS, okay? When you find a company like HIMS that is just now coming into profitability after being net margin negative, now coming into profitability, as we can see, scaling EPS, from negative to positive, it's coming off zero. So of course, the price to earnings initially is not going to make sense, right? That is why it has a very high price to earnings. And although they're only growing at 17% per year, which is very strong for any company, mind you, anything above 15, guys, is fantastic. Get that in your minds, right? Anything above 15, companies would kill for, okay? Even in spite of that, their PEG ratio is very high. If you were to stop the analysis there, you would say this one is not a buy. This is the limitation of the price to earnings ratio, okay? The price to earnings ratio only works for stable, or works best rather, for stable EPS companies. When it's not a stable EPS company, like Micron, or like Palantir, like HIMS, like we just saw, usually fast growing companies where their EPS coming off zero and their PE is really high and their PEG is really high, okay? Look at Micron. This is not consistent EPS. So can I use price to earnings here? Do you guys think is it the same as Microsoft, right? This, I can use price to earnings in the PEG, no problem. Something like a Micron, maybe, just maybe, I have to use more indicators or more valuation ratios than only price to earnings, right? The consistency of the EPS is going to tell you whether you can use price to earnings or not. Visa and MasterCard, look at these. You can use price to earnings, right? And when I'm looking at Visa, mind you, speaking of price to earnings, right? It is always, always, always in relation to its peers and its industry. Always remember that. And also, I should include also to itself, okay? You guys see me do this sometimes. And to itself, okay? When you're looking for Visa, right? If you're looking at Visa or something like that, and you know right now they're trading at a 30, or they were trading at a 30 forward price to earnings, okay? What does that mean? If I look at Visa P ratio history, I like this website right here, Macro Trends. It gives you a lot of data, okay? Where is it trading in relation to its own historical standards? If it's on a trail, this is trailing price to earnings, okay? Whatever you want, use apples to apples, use oranges to oranges, okay? If you look at trailing, then use trailing. When I'm looking to invest in the future, I use forward. But if I'm looking to know, well, where is it now in terms, like, historically speaking, right? Let's go use all the trailing historical metrics. You can see that, you know, when it gets really, really expensive on a trailing, it's in the 40s. When it gets really cheap, it's in the low 30s, right? So if trailing is cheap for the 30s, then forward 30s is also cheap, okay? That's all, like, you can make an extrapolation based on that. It's a very important concept. If trailing 30s is cheap, then forward 30s is cheap as well, okay? So just take that as kind of like a baseline overall, but P ratios work best when the EPS is very stable. So don't get thrown off, okay? If a company has a very high price to earnings, it's one of two reasons. Number one, it either has a very high moat. Number two, it's because it's coming off zero and it's growing really fast, and maybe the PE ratio and even the PEG is not the best. Speaking about the PEG, this is what allows us to compare apples to oranges, right? You see me do this all the time for big tech. NVIDIA, although a tech company, is not the same type of business as Microsoft, is also not the same type of business as Amazon. However, when I look across Mag 7, I use the PEG ratio to get a sense of, amongst all of them, which one is, objectively speaking, the cheapest. And that matters. The PEG ratio can allow us to compare companies within common industries, right? And get an overall sense of whether it's truly cheap or expensive, yeah? So if I'm looking at comparing Amazon and NVIDIA, well, I wouldn't compare them based on a price to earnings metric. I'd compare them based on a PEG. Which one is cheaper based on a PEG ratio overall, okay? That's what allows me to compare between different companies. If you don't know how to do the PEG ratio, it's very simple. It requires a little bit of input on your side in terms of math. I'll show you how to do it one last time. This is the last time. This is the last time I'm going to show you guys how to do the PEG ratio, okay? So what you do is you take, I'm going to have to do this on a separate page. What you do is you take the difference year to year. Use 2024, because now we're into 2025. The only time I'll move 1 year forward is when we get into Q3. Q3 of this year, my new baseline is going to be this. Let me explain, okay? So number one, you do 2025, which is 620 divided by 553. 620 divided by 553. That gives you a growth rate from 2024 EPS to 2025 of 12.1. Write 12.1 down on a piece of paper, okay? So 12. Then you do the same thing for this right here, 730 by 620. 730 by 620. That year-to-year growth rate is 17.7. Let's just say 18. So now we have 12 and 18. Remember those two numbers, or write them down. Now we do 2027 to 2026, and I'll stop there, okay? So 2027 to 2026, 894 to 730. 894 to 730, that gives you 22. So what did we have? We had 12, we had 18, and we had 22, correct? Good. So now we have 52. That is all three combined. We're going to do a straight line average. How many numbers are there? There are three numbers, yeah? Divided by 3, that gives you an average EPS growth rate for the next 3 years of 17%. Okay, 17% overall. All right, on Amazon. So I can even adjust this back here to 20. I can use 17%. It's actually a little bit higher than that. It's actually 18. I rounded down, but I digress, right? The street's giving it a little bit higher, whatever, right? That being said, okay, that's your EPS growth rate for Amazon overall. That's what gives you the EPS growth rate. So then how you derive the PEG is very simple. You take the forward price to earnings. Forward price to earnings is really easy. Forward price to earnings is you take the share price, okay? You divide it by the EPS. Share price of 210 divided by their next year's earnings. So 210, how much is this? 620. 210 divided by 620. Oops. 210 divided by 620. Okay, that's a 33.8. Now, I just said Amazon has a 17, 18% EPS growth rate, yeah? Divide it by 17, and you'll understand that Amazon is right now trading at roughly speaking, a 2 peg. Okay, if I use the true one, 18, you know, if I reduce this EPS here by 10 cents, and I use 18 instead of 20, you know, it'll be roughly a, you know, just under a 2 peg, right? It's getting up there right now. So anyways, that is the forward PEG ratio overall. In a nutshell, I'll remind you, anything under 1 is cheap. Anything between 1 and 2 is okay. Just objectively speaking, just in an absolute value, right? And anything above 2 starts to be expensive, and you have to ask yourself the question, why is it over 2? Why? Sometimes companies like Hims, it's very obvious. It's because they have a low EPS, they have a high price to earnings, and though this is an objectively fine number, it's just not enough to get a good PEG ratio. So then if the PEG ratio is too high, ask yourself why, okay? Is it because it's way out of proportion, or is it because you're missing something? Is it just because the company is growing off of 0, you know what I mean? Apple is a good example of something that's objectively expensive, okay? It's not growing that fast anymore. It's mature. When we divide this by this, you get a PEG ratio of 2.67. Now, Apple is Apple. Sometimes it gets a higher valuation, but this is expensive. This is objectively high for what Apple is giving us right now in terms of shareholders, yeah? Conversely, something like Google, this is conversely very cheap for what Google is giving us right now, okay? It's objectively cheap, all right? If Google was at a 3, then I'd be asking myself some questions. Like, that doesn't make sense, you know what I mean? And sometimes when the market really rallies hard and earnings don't have time to catch up, sometimes too many companies get too high. Meta is objectively fine right now. Netflix, it's still objectively fine, but it's getting up there. If Netflix up here for this same price was a 3 peg, I'd be saying no. But it's a 43 price to earnings. They're growing in EPS at 23%. Keep in mind, they cannot grow at this rate forever. Eventually, it'll come down to like 15, 17, and it'll probably sit there, okay? But, you know, you got to keep in mind, it's starting to get up there. Knowing that this might come down over time, companies cannot grow EPS at 20% forever. It's just impossible. Eventually, the law of large numbers kicks in, and they're only able to grow it between 12 and 16% overall, roughly, okay? Now, that is pretty much everything I had to say for price to earnings and PEG. Hopefully all that makes sense. We talk about it so much. So I figured I should give you guys a little bit of a refresher and how it all intertwines amongst each other. There's a lot of little lessons in there, so hopefully you guys are taking notes. Now, we're getting into a concept called price to sales. This is the backup to this. If you find yourself in some situations where the P and the PEG does not make sense for the reasons we described prior, then you have to look at something called price to sales. Price to sales is often utilized for non-profitable companies because they don't have earnings yet. They're net negative, right? Or companies that are coming off of 0 earnings per share and growing that very quickly to where it doesn't make sense to use this because it's not stable, right? Price to sales is usually used for those style of companies. It's used for other styles of companies, but when you'll see me most use this is for those high growth companies coming out of negative net margins, yeah? I'll give you some example of price to sales, but always remember, it is also relative to the peers and the industry. It is best for inconsistent EPS or negative EPS companies, okay? Because you can't do price to earnings if the EPS is negative. The math just doesn't work. How do you want to divide a number by a negative number or by 0? The math just doesn't work, right? So that being said, if I were to take Hims as an example, this would not make sense because the earnings are growing too fast and it's coming off of zero, okay? That's when we like to use a price to sales. What is price to sales? It's very simple. Price to sales is essentially the market cap of a company divided by its annual revenues. I like to take it on a forward basis always. I love forward valuations because the past is the past. What's the guidance for the future? That's what I always want to know. So forward price to sales on HIMSS, let's say, okay, they're going to make 2.35 billion. Now, a company that is currently trading right now at a 13.68 billion market cap, 13.68 divided by 2.35 divided by 2.35 it's trading at right now a 6 price to sales. Now, a fast growing, relatively new tech company, that's fine. Industry standard for tech is usually between 5 to 10. Anything above 10, you have to start really asking yourself some questions, yeah? If I have a lemonade stand with good margins, right? You guys know lemonade, what does it cost me? A few lemons and some sugar and water. You know, gross margins are going to be good on that. And there's not that much operating expenses, right? So that's tech companies in a nutshell. They usually have good margins. As a result, their price to sales is allowed to trade higher than normal. An average price to sales for tech is 5 to 10. Maybe I should write that down, okay? Price to sales, because we trade a lot of tech companies here. So average price to sales for tech is 5 to 10, okay? 5 to usually closer to 10. If it's 5, it's cheap. If it's 10, it's expensive. You don't want price to sales here. Price to sales by industry. Okay, you can go to this website right here, NYU Stern, and they always update it. This is updated January 25. It gives you average price to sales, right? Here you can see computers and peripherals, 6.46, right? If you'll notice, a lot of other ones are always between a 2 to 3. Okay, usually always between a 2 to 3. But some other ones, if you creep up into, sometimes for healthcare information and technology, 4.71. Other times investments and asset management, like a Berkshire or like a Brookfield or whatnot, they can trade a little bit more rich, stuff like that, because they have higher net margins. Usually, not always, but normally a higher price to sales comes as a byproduct of higher net margins overall. You'll see that all the time, okay? Restaurant and dining is usually a 3 to 4. REITs are allowed to trade up to a 6. That's the average of the industry. If we look a bit further, semiconductors are 14. That's the industry standard. So that should be your benchmark overall. Software is 11. But as you can see, there's nothing that should be trading at 20. Okay? Nothing. Okay? So when I find companies like Palantir trading at a 77 price to sales, does that make sense in any world whatsoever? No, it does not, right? It just doesn't make any sense whatsoever. When I find companies like CoreWeave, which is growing really, really nice, this is a bit of a... Sometimes you got to use your logic, right? Sometimes they'll be trading at very high multiples to their next year's revenue, but when they're growing revenue, see, this is extremely fast revenue growth. This company is growing at revenue here at 100% from 4 to 10 billion. That's a 2x. Then 50% from 10 to 15 billion, that's 50%, and then it tapers off. So if you do a forward price to sales, right? If you only do a forward price to sales, you'll see that this company is trading for a $31 billion market cap. If you were to do 31 billion divided by, what was that? 4.66, right? Divided by 4.66, you might think, well, 6 is not that bad, right? It's not that bad, but it gets even better if you start using a year after which it gets normalized. You'll always find one. After which sales become normalized and growth becomes normalized, you'll see that right now CoreWeave is only trading at 2 times for 2027 sales. That's actually not that bad. You can make an argument that the investment may be worth your money when it's growing that fast. See how everything is relative here? You have to use logic. Overall logic. These growth style companies, I'm throwing them at you because they're the most complex examples. If I were to do my entire video today only using Microsoft, you guys wouldn't learn anything, right? You really wouldn't. Because Microsoft, I could take it, it's always relatively standard, right? Microsoft's a $3 trillion company, so how many billions is that? That's 3370. 3,370 billions, divide by 278 billion, right? Divide by 278. And you see Microsoft trades right now at a 12 price to sales. Microsoft always usually trades at about a 10 price to sales, usually, okay? Big tech, always the same. Depending on the company, between, 7, 8, 10 price to sales is somewhat fair for tech, okay? When I'm looking at HIMS, a fast-growing company right here, you want to use the price to sales metric. You really want to use the price to sales metric because the EPS doesn't make sense. This gives you a better indication. Is the company fair? And also allows you to project into the future. When you don't have constant EPS, you can use price to sales to project in the future. You guys see me do it not so often, but on these companies, I will do it, right? If you were to say that HIMS as a technology company should trade around a between 5 to 10 price to sales, you get a range. If I want to know what the price of HIMS can be in 2028, if they keep this revenue growth constant and this number is adequate, I can take 2028 sales of 3.91 billion, multiply it by an average price to sales that the industry and the stock should trade at of 5, and I get a terminal market cap here of 19 billion. Now, right now, the company's trading at 13.68. How much upside is that? Well, I'm glad you asked. Divided by the market cap right now, and that is your upside appreciation from now until 2028. That's 4 years. 42% divided by 4 is 10% per year compounded. Well, not compounded, but straight line, right? It's 10% annualized ROI. That is the baseline. If you want anything more than that, you have to expand HIMS's multiple. Okay, let's say you think that maybe Wall Street will allow it to trade at a 7 multiple or maybe a 10. Give yourself a range. 5 is base case scenario. 10 price to sales is utmost bull case scenario. 10 times 3.91 is 39 billion market cap. That's the top end of the range. Okay, 2028. So we've allowed the multiple to expand times 2 to what it normally trades at and what maybe some of its industry peers trade at. If I go into telehealth here, I don't know if they have telehealth, but they must have something similar in here in terms of health. Healthcare, maybe healthcare information technology, right? Maybe 5, something like that. If HIMS somehow hits peak bull, 10 price to sales, and goes to a $39 billion market cap, well, then the range is different. It's 39 divided by 13.68. You're looking at almost a 3x. So you're either looking at 42% or a 3x. Maybe it's somewhere in the middle. Okay, maybe you take an average of that. I just gave you the base case and the big bull case, right? Maybe it's in between. Okay, that could be your upside appreciation. So price to sales, this is how you measure if a company is trading fair in relation to its sector and also in relation to itself, right? If the valuation on HIMS right now, even price, if this was a $13 billion company making $100 million a year, then this price to sales would be ridiculous. It'd be like a 40, 50, whatever price to sales, at which point all metrics would be expensive. And you know you're not getting a good deal no matter what you look at. Okay? So hopefully that makes sense. Price to sales only makes sense when you really look at these high growth companies, because if it has consistent earnings, you should just be using P and PEG. So the only examples I'll use today are companies in which you truly have to use price to sales, right? The other time you'll use price to sales is when you're looking to see, has a company gotten too cheap across all metrics? And sometimes that doesn't even matter. You know what I mean? Sometimes it doesn't even matter. If I go to healthcare here, where's healthcare? Okay, healthcare support services, so to speak, right? Sometimes these healthcare support services are not so easy. They're really not so easy. Sometimes life insurance as well. See, life insurance here trades for usually a 1 price to sales with 19 different companies involved in it, right? We don't have health insurance here, but if you want to derive health insurance, it's between life and maybe healthcare support services, right? Maybe a 1 to 2 price to sales. So a company like UNH, to bring up this example, right? It's trading at a 0.64 price to sales. Objectively, it is cheap. Well, I'll remind you, a company like Centene Corporation, which also does managed healthcare services, insurance, and whatnot. They have a 29 billion market cap, but look how much money they make per year. Okay, $163 billion. So this company is trading at a 29 divided by 164. It's trading at a 0.2 price to sales. You would think that's cheap, but sometimes it doesn't matter if it's cheap. The company still won't go up. So valuation is not the end all be all, right? It's really not the end all be all. It helps in determining if something is worth your attention or not. But just because a company is cheap does not mean it has to go up. It helps, but it doesn't mean it has to go up immediately. That's a fallacy, right? Just as if Palantir's been expensive since here, it doesn't mean it has to go down, right? It can get more expensive, more expensive, more expensive, more expensive. So valuation is only a tool amongst many other tools to determine whether or not a company warrants your attention or not. Hopefully that explanation of price to sales helps you, especially when you're looking at companies like CrowdStrike. Cybersecurity have very high price to earnings ratios because they have not scaled into profitability. They make a ton of revenue, but they don't make that much net income. And as a result, net earnings are not translating to earnings per share. Not yet, at least. It's coming, but not yet. Okay? So maybe, just maybe, we should use something like a price to sales. And even on a price to sales basis, even though they're increasing sales by a wide margin here, even cybersecurity, for the most part, 108 billion divided by 5, right? 108 divided by 5, that's about 25 something, right? 105 divided by 5, 21 forward price to sales. So, objectively speaking, on a price to earnings and a PEG ratio, this is expensive. Even on a price to sales, it's extremely expensive. I don't even know if they have cybersecurity here. Probably not. But if I just look at cybersecurity industry price to sales, maybe I get a better indication of what I'm looking at here. Let me see if it gives it to me there or not. Price to sales ratio by industry. I don't want to go too long here. Do they have cybersecurity? No? Okay. Well, maybe not there. Can I get a good one here? No. I guess I can't. Well, most of all of them, okay, never mind. They're included in a different segment. I guess they're too new. I don't want to spend too much time on this because it's already about an hour. But just to show you guys that a lot of these cybersecurity companies have the same thing. Look, Cloudflare, 20. Yeah. Palo Alto Networks, this is a $126 billion company. And this last year, they made $8 billion in revenue. I won't take forward. It doesn't matter. Okay. But just look at this, right? 126 divided by, what did I say? 8? 126 divided by, what did I say? I think it was 8, right? I just want to be fair to the company, right? Divided by 8. See, that is also at 15.75. So they're all expensive, but this whole industry trades rich because it's in very high demand and it's one of the fastest growing industries in the market. Eventually, these companies won't trade at forward price. They won't trade forever for the next 20 years at 20 times price to sales multiples. Eventually, the whole industry will consolidate and the revenues will taper off, or they'll grow into their valuations. It's a fast burgeoning industry, but eventually there can be time periods where after all that growth, maybe sometime in the next few years, maybe again, you get a consolidation phase where the companies grow into their revenues. The revenues are increasing, and maybe then the standard industry price to sales for cybersecurity becomes something like a 12 or something more manageable. You know what I mean? Maybe. Remains to be seen, but that's a fast growing industry. But hopefully that gives you some cues as to which companies you should be using price to sales for. Usually it's these two criteria, or usually it's these two, right? Inconsistent EPS or negative EPS. It's usually fast growing companies. And then once again, always compare it relative to its peers to understand whether or not it makes sense. Okay. Now, last but not least, we will talk about free cash flow. The other most important thing that you always hear me talk about, free cash flow. What is free cash flow? Good question. So free cash flow is, you can read the theoretical definition. It might sound like a bunch of jargon to you. I'll explain it in the easiest way you can understand, okay? It goes back to when we were talking about revenue minus cost of goods sold, okay? Into operating income minus the cost of the operations. Then you have operating income. Now, from this money, a few other things are subtracted, okay? However, where you find the free cash flow, it'll all make sense. This is the money that the company has to pay back a few things. Debt It can pay out dividends with the free cash flow, or it can pay buybacks, okay? So here's how it works. Here's Microsoft's cash flow statements. Here you can see net cash from operations. These numbers should be largely the same in terms of when we go over them. Should be largely the same, except for sometimes they readjust them anyways. It's not the point. I can get into that. I could do a discussion on how operating translates into operating and cash flow, a number of different reasons. But anyways, I digress, okay? All you have to understand is it's net income plus a bunch of other stuff. Never mind. Net cash from operations on the cash flow statements. This is after the company has added in several different things, like a bunch of different other things. That's not really important right now. Net cash from operations, the business's operations after a bunch of different, tax and accounting manipulations here, okay? When they have their net cash from operations, how much of this cash do they have to pay down? Do they have to pay down debt? And also, right, how much of it do they have to invest? Now, Microsoft has it flipped. Usually on most cash flow statements, it's the other way around. Investing will be up here and finance will be down below there. You can see it on any template, right? This is a template when you go through corporate finance classes or whatnot. You'll always see it's operating activities, then investing activities, then financing activities. It's unfortunate that it's not the other way around because usually net cash from operations is here. And then the very first line is additions to property and equipment. This is what's called capital expenditures, CapEx. When you guys hear CapEx, 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 that's what it means. Additions to property and equipments. Tools, machinery, buildings. Okay? Keep that in mind. I don't know why my internet brokers just went off, but anyways. Additions to property and equipments. Net cash from operations minus additions to CapEx, okay, gives you free cash flow. What does free cash flow do? It allows you to either invest in other things, such as other investments that you want to do for the company. This is what Google will use for its other bet segments, like Waymo or whatever, when a company has other investments it wants to make in different divisions or whatever, okay? Then after it's done the CapEx and first things first, it'll look to pay down debt, or you'll see here, it'll look to repurchase stock, or it'll pay dividends. So net cash from operations, how much money the business made, okay? Then from that money from the operations, this is not net margins. Net margins are here, net income. Then they gross up a bunch of stuff. Then you get what you call net cash from operations. I know it's confusing, but just follow along here. Free cash flow is how much cash the company actually, it's free cash. Like at the end of the quarter, how much money does this company actually have, okay, to finance stock repurchases or repayments of debt or pay dividends or invest into other things, okay? That's when you get free cash flow. This minus CapEx equals free cash flow. They use for financing activities, such as the ones we just talked about, or investing activities, okay? Why does it matter? It's because several of even investment, you want the company to make investments in itself, right? Or other bets or stuff like that. But you also want to see, are they repaying their debt? Are they buying back stock? Are they paying dividends with it? Okay? This is your money. This is why it's so important. This is your money as a shareholder. It is your money. This is the company that the company should be paying back this money to you in XYZ fashion. Some of it will be for them to pay down debt, but that advantages you as a shareholder because then the company is less of a risk of going bankrupt, right? But a lot of this free cash flow is yours because you want to see them pay it to you this way or pay it to you this way. The more shares they buy back, okay, the better the earnings per share get. Why? Well, because earnings per share is earnings per share. If it's E over shares and there's less shares, well, obviously earnings go up. This whole ratio goes up, okay? So you want there to be less shares in circulation than more shares, right? It's just very logical, yeah? Okay, so that's why free cash flow matters so much to everybody. Now, if you follow someone like Warren Buffett or you follow someone like Benjamin Graham, if you read The Intelligent Investor by Benjamin Graham, who Warren Buffett looked up to, mind you, he's known as the godfather of value investing, so to speak. Mr. Benjamin Graham, highly suggest you guys read that book. It's not outdated. It was written in the 1970s. I think it still holds several concepts that you guys should be willing to understand in terms of all this, how to valuations of companies, pros and cons, different industries, relative metrics between one and the other, a lot of which I've talked about today, right? Okay, but at the end of the day, free cash flow yield, a lot of people, now this is not an exact science, but I'll just throw it out there. A lot of people say that if the free cash flow yield is not above the short-term 5-year risk-free rate of government bonds, it's not a good investment. Because you could get the same yield. You can get, if a company's trading at a 4% free cash flow yield, right? Company's trading at a 4% free cash flow yield, but the company has risk. It's a publicly traded company. It has risk. It has the risk of the economy. It has the risk of anything. Would you rather buy a company at a 4% free cash flow yield, which is your money, technically speaking, or would you rather invest in a risk-free bond? Most people would say the risk-free bond, right? That's, it's not a myth. It's not a legend. It's kind of corporate finance 101. It's a unwritten rule that some people like to abide by if they're really hardcore value investors. I don't abide by it so much. I just look at a range. My range is between 2.5% to 5%. Anything under 2.5% free cash flow yield is not that great. Anything above 5 is really good, okay? But it's also relative. Sometimes when it's too little, it means the stock is perhaps too expensive, okay? Now, how do you calculate free cash flow yield? It's very simple. You take the company's trailing 12 months of free cash flow. If you want to be really fancy with it, you take the actual trailing 12 months. You can see here that we're in the middle of a year right now. You would do this. You see this number in blue here, free cash flow? You would take this, plus this, plus this, plus this. That is TTM. Whenever you see TTM, it's trailing 12 months. The combination of these four would be trailing 12 months. That's the actual way to do it. If you want to do quick math, you can take the one from 2024, but then again, you'd be missing this Q1 2025 quarter, yeah? You can take 2024, or you can just do what's very simple and just do this, Netflix free cash flow yield, okay? Type it into Google, and you'll find that, for the most part, okay, Guru Focus will give you one, right? Normalized free cash flow yield of about 2.5%. Just look at a few of them, okay? Just look at a few of them. You'll see them in around here, okay? I think it's free cash flow margin. I digress. You'll find different ones, like you can find different ones all over the place or whatnot. If you really want to calculate it, just take some of these numbers, okay? You see 1.5, 2.5. So you should think it's between 1.5 and 2, let's say something like that, between these two websites. Depends which ones they use, right? And when they measure the share price, some of these websites update daily. Sometimes they update once per quarter. You never know which one the website uses. If you want to do the math yourself, you can use TradingView. As you'll see, we'll do it right now for you on Netflix. I'll just use Netflix as an example. You take those websites as a benchmark, then just compare it, but you should be pretty close. So 2.66 plus 1.38, 1.38 plus, 2.66 plus 1.38 plus 2.19, 2.19 plus, what is this one? 1.21, 1.21. You can see I got it all there. That gives you trailing 12-month free cash flow, 7.44. You divide this number by the market cap. Okay, 7.44 billion divided by 489 gives you a free cash flow yield of 1.5. So I guess these websites were correct. 1.5%, yeah? Okay. So sometimes these use every quarter or whatnot. Here there's two. Netflix's current free cash flow yield. I would just click on it and see what it is. You know what I mean? Just go into here. Okay, Netflix's free cash flow yield. Sometimes Google gives you two numbers, like in terms of that. But if you just go to this page right here and it says free cash flow, Netflix free cash flow, okay, free cash flow yield, you'll always find it. Okay. So usually these websites are in line with what it is. Here you can see I did it manually and I came to the same result. It's about 1.5. Okay. So now being a bit higher, see, I was at 1.78, but that's because I did it at $1,100, right? Now it's a bit higher. It's a bit lower. Anyways, that being said, okay. I didn't adjust this, by the way, since I did it at 1,000. I adjusted this. I didn't adjust the free cash flow, just so you guys know why it's so off. If you're doing the math and you're saying, well, that doesn't make sense. 1,100 would only be this much lower. I cheated. I updated these the other day when I wanted to film the YouTube video for the market recap. I did not update this. Full disclaimer, I'll just do it right now in front of you. It's 1.5. Okay, 1,150 bucks roughly. A free cash flow yield at 1150, I guess. Okay, so we'll just make it really exact. Yeah, anything under 2.5 is very low. Okay, traditionally, if it's a mature company, they'll always trade between 2.5 and 5. I know because I follow these companies for years and years and years. It is very rare to find Microsoft at a 4 free cash flow yield. Since the free cash flow yield is an expression of free cash flow divided by market cap, okay, it's free cash flow divided by market cap, okay, let's call it market cap. Well, one of two things needs to happen if you want this ratio to go down, okay? Either free cash flow, or rather, if you want this ratio to go up, okay? Either free cash flow has to go really up really fast. Is that going to happen for Microsoft? No, they're too mature. They're already into that cycle already, right? Either this has to go up really, really, really fast, or this has to go down really, really, really fast. Microsoft, during a correction like we just had, free cash flow stayed constant. It actually stayed and steadily increased. What happened, though, is the market cap went down. That's when the free cash flow yield will get higher, okay, for a company like Microsoft overall. So hopefully that makes sense. Normally, when you're looking at big companies that are trading around, well, historical price to earnings ratios and historical ratios overall, the free cash yield on Microsoft is always going to be low. It's there. I don't think I've ever seen Microsoft above a free 4. I think back in 2022, the bottom end of the 2022 market, that was the only time that I saw Microsoft around a 4. 5 is I've never seen Microsoft at a 5. A company like Visa as well will always be around a 3, rarely a 3.5, mainly only during times of correction, rarely around a 5. Other companies, when they drop a lot, they'll have high free cash flow yields. Like Google right now, although it's not at its low, when it was close to a 4.5. If you find big tech at high free cash flow yields above 4 or above 3.5, that's pretty good. That's really good, as a matter of fact. Companies like Costco, you'll never find them above a 2, unfortunately. Okay. So free cash flow yield is also something relative. Free cash flow yield is not my end all be all at all. It's like a final little thing that I like to see. But one thing that I do want to see, guys, for every single company is I want to see increasing free cash flow over time. That's the only thing I want to see. You can see that here in this little financials page on TradingView here. Free cash flow on a yearly basis. I want to see free cash flow go up. Mostly every single year over time. Here's Visa. Okay. I want to see it go up over time. It won't go up every single year because sometimes companies make investments during a single year, right? Free cash flow, as you guys know, it's after CapEx. Sometimes companies reinvest back in each other. That's fine. But over time, you do want to see it move higher. You can do Visa, free cash flow history, and you come to the same macro trends page here. You can see free cash flow over time does grow. Some years it'll be weird, but over time, you should see a net increase in free cash flow, such as Microsoft, right? Microsoft, free cash flow up and to the right over time. Sometimes it's justified because they're reinvesting in their business. For the most part, though, they should be going up and up and up over time. Okay? It just lets you know the company's doing a good job of managing its cash. And with that free cash, it's going to be able to pay you back. So on average, you'll want to see free cash flow. You'll get to know them, guys, like the back of your hand, like me eventually, just the more that you see them, okay? Don't come to me and ask me, well, why is the free cash flow on him is really trash? Well, because they're just now net margin profitable, guys, right? They have okay free cash flow, pretty good for what they are. But if I do the ratio of free cash, like 200 mil, right? Like 200 mil divided by 13.68 billion, right? Is like a 1.4% free cash flow yield. Don't ask me, well, do I not invest in HIMS because the free cash flow yield is low? Give them a chance, man. You know what I mean? You gotta give these companies a chance. Palantir, it'll never be high because Palantir is just ridiculously expensive right now. But sometimes you'll find something that's off, right? Let's say I was looking at I don't know, let's say I was looking at oil and gas, right? Let's say I was looking at oil and gas, and I don't have the free cash flow yields up here, unfortunately for me, but I'll just give you an example, right? If ever you're looking at these and you find an anomaly, let's say oil and gas, even though it's not consistent, I'll just take it for an example, right? Free cash flow is 30 billion. The company's worth 467. Sometimes you'll find really high free cash flow yields for a lot of these somewhat more defensive stocks. Yeah. So if I do 30 billion in free cash flow divided by 467, you'll see that's pretty good. It's like a 6.4. Okay. Sometimes you'll go through a number of these oil companies and you'll see that they're all trading between a 6 and an 8% free cash flow yield. Okay. But then you'll find one of them, okay, that although the chart looks good, I don't know if Oxy's like this. I don't know. But maybe you think the chart looks good on Oxy, but all of its sector peers have a 6, 7, 8% free cash flow yield. But this one, for XYZ reason, let's just say the free cash flow was garbage, okay? And you're looking at it and you're like, well, if I were to do the math right here, that's 10% free cash flow yield. So don't let your eyes fool you. It looks small, but in terms of the market cap, it's big. But let's say Oxy Warren Buffett owns and whatnot. I'm just taking it as an example, okay? Let's say the chart looks good and you're looking to buy an oil and gas stock and you're looking to find the one that's the best bang for your buck. But then you see it has a free cash yield of 1%. That means that something's wrong, okay? Something is wrong because the price has come down, but the free cash flow also got crushed. You need to understand why. What is the company burning its money on? Okay. What are they investing in so heavily that has reduced their free cash flow by such a drastic amount compared to sector peers? Then you should have an answer. Okay. If you compare Visa and MasterCard, which are legacy networks, free cash flow yields very low because their valuations trade very high. MasterCard, okay, growing at 11 and 14%. There's MasterCard, there's Visa, then I have 12%. Then you got American Express. American Express is growing roughly at the same clips, okay? But you find a free cash flow yield double its industry peers. You know that, and at half the multiple. Now, this is because you have to know a little bit. American Express owns its own debt. It's its own bank, okay? So that's why it doesn't get the same multiple that Visa and MasterCard get, because it doesn't have the same margins as Visa and MasterCard. Look, they don't have the same margins, not even close. Okay. And there's more risks. They hold their own debt. They're their own bank. But it brings in a tremendous amount of free cash flow. So at a 16.4 price earnings, at a 1.26 peg at 250, and a free cash yield of 6%, you know that, okay, well, maybe this company is worth the risk. It is indeed worth the risk. The free cash yield is there. They're making a lot of money. They're making a lot of money, which allows them to pay a nice dividend. But also, it allows them to, okay, do this. Buy back some shares, right? In a very aggressive manner. So that's how you know, okay, this stands out to me. This is very high. I know that on average, companies are usually only supposed to show 3 to 5%. If I find an anomaly of something at a very good price and the free cash yield is above, this is a somewhat mature company, and the free cash flow is above the standard that I normally see for every company, which is 2.5 to 5%, well, maybe this one is worth a second look for an investment, right? So it's all relative. That's why you see me use them in relation to each other, okay? So too little means the stock is too expensive, perhaps, or they're spending too much money on something, and if that's the case, you need to understand why. Too much free cash flow, okay? If you find a free cash flow yield of like 10%, like Baba, well, Baba no longer, but when I used to cover these, let's say like Baidu or something like that, you cover Baidu or whatnot, free cash flow yields are ridiculous. But that's just because the stock is so cheap. The business is not bad. They're not underinvesting in the business. However, the valuation is just crushed. Like they make good free cash flow, but the valuation is just destroyed because it's just been down for so long, which is why a lot of people look at these companies and think, oh, it's an amazing deal. Well, yeah, if you can get over the risk of China and their economic conundrum right now, which is, are they growing or not? When will they get out of the recession? So if you find something that's too good to be true, one of two things is either problematic. Either there's an entire narrative at play for an entire segment of the market, or something is wrong. Why are they underinvested? Why are they retaining that much free cash flow? Okay. Why are they not investing in something? It's just like when a company's dividend yield is too high. Sometimes a dividend yield can be too high because the company's stock price drops and they keep dividends constant. But sometimes when a company's dividend yield is too high, are they underinvesting in the business? If a dividend yield, if they have too much free cash flow, they have nothing to do with their cash, right? Are they buying back shares? Why can't they use more of that money for the growth of the business? Then you may have found a company that has possibly reached the total addressable market. It's not growing anymore. It's not innovating, right? So too little, you have to look into why. And too much, you also have to look into why. Too much is great for software companies. It means their prices come down, even though they're still growing. But too much free cash flow for a product company, well, maybe the company is lacking innovation, right? Maybe they should be using more of that free cash flow and not doing as many share buybacks and not doing as many dividend payouts, and maybe reinvesting some of that juicy free cash flow into their business to try and, break the mold. Shout out to Apple. The free cash flow is not high, but they generate a ton of free cash flow, but they use most of it for buybacks, which is great for shareholders, but maybe not so good for innovation. I don't know. It's a thesis, right? It's like, it's not black or white. It's gray. Some people love the fact that they use all of it for buybacks and dividends. Some people don't. Some people wish they would use more of this money to innovate and stay ahead of the curve and take more risks, right? That being said, this is not bad. Okay. All right. So those are all things that kind of come together for free cash flow, but hopefully that all helps you out. As I said, it's all relative. You will have to see many, many, many different companies and many different industries for all of this to make sense and have a good handle on it as much as I have right now. But I'm trying to explain to you guys the logic and the links that I'm making here in this video are far more important than you sitting on YouTube watching some guy give you theoretical examples of a non-existent company, of what free cash flow is, of what price to sales is, of what price to earnings is, of what profit margins are. What are you going to do here? Study a theoretical cash flow statement and say, oh, this is free cash flow. No, right? I'm trying to give you real world examples comparing across different companies and how you think about them logically. Nobody explains the logic. Very few people do. Books like Benjamin Graham, The Intelligent Investor, those explain more about the logic. But then again, the companies that are referenced back in the time that book is written, the times have changed, let's just say, right? So I'm giving you an updated version of how to do this, of how to use your logic and reason. Financial valuation and fundamental analysis is as much mathematics as it is using your logic and reason, okay? That's the most important thing. It's not just, I need to follow a set of rules for price of earnings. I need to follow a set of rules. A profit margin for X company should be this. A price of sales for this company should be this. The free cash flow yield for a company should be this. No. As I said, okay, all of this is relative to many different things. It's peers, it's industry, and sometimes even itself. And you have to use logic. Why are things the way they are? Okay. Will hint at you what stage of the company's cycle it's in. Is it a high growth company? Is it mature? Is it just looking to defend its market share? Is it spending money for innovation? Are they good projects or bad? What's the ROI supposed to be on those projects, right? All of these things come into play when you look at fundamental analysis, but it is just one piece of the puzzle, right? Okay. So that's pretty much everything that I wanted to cover in today's video. Obviously, there's much more than this, guys, but this is a very well-rounded introduction to it, I think. It's over an hour. I think you guys will learn more in this hour about fundamentals, but like I said in everything, right, than you would learn anywhere else. But like I said, right, it's practice. The only reason that I know that banks have this stuff, tech companies have this stuff, pharmaceutical companies have this stuff, right? The only reason I know is because I've seen thousands of them. Thousands. You know what I mean? So it'll all come with practice. When you've seen many, many tech companies and you get used to the normal gross margins, the normal operating margins, the normal net margins, the normal price to earnings to be expected, the normal price to sales, the normal free cash flow, depending on the cycle that the business is in. Is it in a high growth phase? Is it in a maintenance phase? You know, once you've seen a lot of them, you'll be able to say, oh, okay, that makes sense. Oh, okay, that doesn't make sense. And then you'll be able to find problems, right? Or you'll be able to find deals. But like I said, it is not the end all be all. It is not the end all be all. Not even close. The name of the game is solid fundamentals, but also a great technical entry too. Don't forget about the technical analysis. Don't forget about the macro sentiment as well, right? The stock-specific sentiment. Okay? No amount of fundamental analysis is going to save this company right now. I can guarantee you that. It's just not going to happen. You can cry to me that it's cheap, that it's hitting. Even no amount of technical analysis is going to save this company either, mind you, right now. This is when, see, it's like a pie chart, right? You have technicals, you have sentiment, and you have fundamentals. This pie chart moves. Sometimes sentiment takes the entire portion of the pie, and that's all people focus on. The flip side of that is Palantir. The technicals don't matter. The fundamentals don't matter anymore. Clearly, all that matters is sentiment. If people believe it's a $1 trillion company, they'll keep buying and they won't sell. Okay? If people believe UNH is going to zero, they won't buy it. They will just continue to sell. Right? Who's to say whether or not they're wrong? You may think they're wrong, but you cannot change when sentiment becomes the entire portion of the pie. Okay? Technicals sometimes are more of the pie for certain companies. Fundamentals sometimes are more of a pie, but the pie is always three: sentiment, fundamentals, and technicals. Sentiment is the only one that can erase the other two as if they're not even there and become the entire pie sometimes. But usually it moves in terms of percentage. Sometimes technicals are a smaller portion of a stock. Sometimes it's all about sentiment and fundamentals for that stock. Technicals don't really matter, right? Sometimes it's mostly about technicals and fundamentals, and sentiment rarely ever matters. Like Visa. Okay? Like Microsoft. So it's always a pie. It is always, always, always a pie of these three factors, which is why I should say, okay, on this one, I should actually say that, where did I write it? Well, the name of the game is a solid fundamentals and great technical entry, but I should also say, don't forget sentiment. Sentiment is not a reason alone to get into a stock, by the way. Normally, it helps. Fundamentals and technicals should be the main reasons to get in, but sentiment definitely helps. If you only get in because of sentiment, then you're absolutely going to get steamrolled most of the time. Okay? That's why I only focused on these. Because sentiment goes really hot, then it goes cold, but what remains is always this, and what remains is also this. Okay? So keep that in mind. All right? So that is my very long explanation of, well, not very long, but that is my introduction to fundamental analysis. If you want to ask me questions in the live streams or in the chat, feel free. If you have questions on this video, please include a timestamp. If you say, hey, Will, I didn't understand what you were talking about here. Can you explain a little bit more? Please reference a timestamp, because in this video, I've been talking for an hour and a half, and I have no idea when I talked about certain, well, I do, but you know what I mean? Like pinpoint. If you want me to revisit some things, no problem. Or if you want to ask me examples in the live streams, like, hey, I was looking at a firm's margins. Can you explain what's happening here? Bring me some context. Show me that you've done a bit of work on your own, and I'll be glad to help you, right? Ask me like, hey, like a firm has high gross margins and decent operating margins. Like, why are the net margins so low? You know what I mean? Like, you want to ask me questions like that? Sure, I'll show you why. You know what I mean? We'll go through it together. But that's everything I had for you guys tonight. Hopefully you enjoyed. Watch this video a few times if you have to. But that's it for me. Take care, and I'll see you guys in the Discord. Peace.